a bunch of people in a room, and they're all wearing funny colored jackets, and they're shouting at each other and waving bits of paper, right?
70 bit.
This kind of raucous,
Montana 23.
people screaming, trying to figure out what a price is. And we have this sort of iconography, this cultural iconography of how the financial system works that is, in large part, completely divorced from reality.
It may surprise you to learn that most of the stock trades in the U.S. are no longer being made by human beings, but by robot computers capable of buying and selling thousands of different securities in the time it takes you to blink an eye. These supercomputers, which actually decide which stocks to buy and sell, are operating on highly secret instructions programmed into them by math wizards who may or may not know anything about the value of the companies that are being traded. It's known as high-frequency trading, a phenomenon that swept over much of Wall Street in the past few years and played a supporting role in the mini-market crash last spring that saw the Dow Jones Industrial Average plunge 600 points in 15 minutes. Most people outside of the industry know very little, if anything, about it. But the Securities and Exchange Commission and members of Congress have begun asking some tough questions about its usefulness, potential dangers, and suspicions that some people may be using computers to manipulate the market. The crash contributed to the crisis in confidence on Wall Street. Since last spring, people have pulled $70 billion out of mutual funds. And the biggest concern of Chairman Shapiro and Senator Kaufman is that average investors have lost faith in the integrity of the system.
It's like a foreign planet. It's a foreign planet with a lot of money, but it's not one that's really designed for us as humans. We don't really survive there.
In 2006, the New York Stock Exchange opened up this room. It's the size of 3 football fields, filled with nothing but
rows and rows of servers, different specifications.
So these are owned by banks, hedge funds, brokers?
Yeah, a whole number of financial institutions.
Are these things trading right now?
Absolutely.
It's clear that everybody in our business uses all sorts of means of networks and communications to get information, whether it's social media, whether it's data feeds, watching news stories that are out there. So clearly we rely on information to help our markets find its trading range. But what we saw yesterday was something that I don't think we've ever expected to see, and the effects that it had on the market is really an eye-opening experience for us. Because clearly, when that one tweet did come out, without confirmation on it, people reacted and computers reacted in a fashion in which the markets became very volatile to the point where we were up 150 and we traded down 150 points within seconds, and then right back up again. So it just shows me that we're relying a little bit too much on technology and relying a little bit too much on unconfirmed sources of information that's out there before we start making the right trading decisions.
Usually when I think of technological glitches, I think of, say, with Facebook and their IPO when that happened. But now social media has come into play. How has Twitter kind of changed the way news comes out for traders?
So, you know, I'll use the term back in the day. Back in the day, people watched the news feeds and they would watch the scrolling news feeds just like we would watch the scrolling tape. Now, we watch Twitter for information, and there's scrolling information that comes out there. There's other sources of information that are pulled from the internet that compile it together and produce it in a nice, neat fashion. So we're looking at all different types of data and information that's out there. What we have to remember is, where is this information coming from? How is it getting there? And is the information confirmed, and is it coming from a confirmed source? This is a very interesting lesson that we've seen here in the situation that happened yesterday. We talk about technology, we talk about computers in our markets, and there's different areas to address there. One is, this is something that was not on anybody's radar screen. We had the flash crash, and then we talked about that and realized how can we prevent this from happening. We had the issue with Knight. Once again, had a conversation and had different inquiries as to had this happen and could it happen again. A bad tweet coming out has never been discussed and has never been looked at as the effects that it's going to have on the market. And then take that another step with the computers that trade and trade off of headlines and looked for negative headlines, look for negative keywords that are out there, and then those computers start trading off of that information. That's exactly what we saw yesterday. That was all computer trading, algos just chasing after each other, trying to beat each other to the next bid that I was trying to hit down. Many bids were getting canceled, and before humans could make the right decisions, the computers already made bad decisions.
And finally, do you think that technology will bring about a faster market crash in the future?
What's happening now is that technology is moving faster and developing faster than the rules and regulations of our market structure here. What we need to do is to continue to look at these instances, and they're very insightful, expensive lessons and experiences that are going on here, and to see how to prevent them moving forward. You can't always plan for the perfect storm to come, but you have to put means and measures in place. So how do you do that? Technology, algorithmic trading has become too dark. It needs to be more transparent. Our markets have become so fragmented that we don't need 60 liquidity centers out there. We need maybe 5 centralized marketplaces that can handle all of this information, that can have speed bumps in place when things get erratic. We need to bring back more of the common sense interaction into trading as opposed to letting computers make decisions. So once again, I know this ball is going to get thrown back down to Washington, so to speak, to the SEC, because there's going to be more studies and more examples of how this happened, why this happened, maybe some examples of how it could have been prevented and how do we stop it in the future. It's really up to the SEC's stance right now to make a firm decision as to how to prevent this from moving forward.